We continue our discussion with the Reserve Bank Governor, Mr. Lesetja Kganyago, and we've explored some of the issues, constraints in this economy, and we continue down the same path. We heard recently from the Minister of Finance that South Africa has got is it 3 trillion debt that is going to grow by 50% over the next 3 years to 4.5 trillion. And then you were mentioning the growth rate of 0.5%. Two parts to my question. How is this debt made up? You know, it is debt for what? If the infrastructure programs that we're talking about are not visible or may not have materialized, one. And two, why is it that we are going to grow the debt by that amount and yet the economy is growing at very anemic pace? You know, 0.5% is not going to make much of a difference.
I think the Minister of Finance dealt with that and spelled out his worries about this thing. It will be very nice if you get him in this sofa and ask him to spell out these things, because I think that it is actually a very useful conversation to have.
Let's jump back then to the earlier. At what point was the debt of South Africa manageable, right? And how much money was it then? Because I recall there was a time when it was ratio of 26% to the GDP, and now it's standing at almost 60%. And these are things that probably worry you and your colleagues at the Reserve Bank. So what was the situation then? The ratio was 26% to 100. What was the size of the debt as compared to now? And in relation to the GDP that depends on growth.
At that time, the debt was just under R1 trillion.
Yeah.
How do I remember that? Is because when I left the Treasury in May 2011, the debt had just jumped the trillion rand mark. I think that what's important is to, as you were asking, what was happening then. What was happening then when the debt was at 26% of GDP? We were rated single A by Moody's, which meant that we were able to borrow cheaper. The foreigners viewed us as less risky, and we had both the fiscal and the monetary policy space to provide stimulus to the economy, which is exactly what we did at the time. And after that, the questions can be asked to the Minister of Finance.
Because, you see, I'm sitting here in this chair, obviously, trying as best as I can to get the answers to the questions that ordinary South Africans ask themselves. As they manage their daily lives, they think about these things. They say, okay, 2011 it was 1 trillion, or just above 1 trillion, and the GDP was at another level, but it was still very low. And they say, but how do you jump from 1 trillion to 3 trillion in 7-8 years?
It is a correct question to ask.
Because, you know, Governor, please comment. I would think like this, that if you move your debt to 3 times what it used to be, then the GDP itself should be 3 times what it used to be. That would be my way of thinking.
Yes, it should be, if the debt was invested in things that generate economic activity that leads your economy to grow. So, put simply, if you borrow money to buy a house and your house appreciates in value, the amount of debt relative to the value of your house, if you have been servicing it adequately, declines. It's the same for countries. But like I said, that is what a treasury and government should be thinking about.
But it's part of your responsibilities here at the Reserve Bank, right, to manage our currency, inflation, pricing,
yes,
and so on, right? And these things that we're discussing now do have a bearing on the decisions you take together with your colleagues, isn't it, in terms of the monetary policy of the country as well as the inflation targeting and related things.
So let's put it this way.
Yeah.
Before any lender in this country would want to lend to you and I, or to any business. They look at what rate they would lend to government. Put simply, government is the most trusted borrower in the economy. Now, how do these things feed into the kinds of decisions that we make? The rate at which government borrows is made of three components. The first component is, what is inflation today? Why is that important? It is important because the people who lend you money would like protection against inflation. It's no point for me putting money in a bank or in a government bond or lending it to you, and I lend you that money at 2% and inflation is 5%. That means I'm losing 3% every year. And so any lender, even to the government, will say, what is inflation today? The second component is, what is inflation likely to be in the future? And that is where central banks come in. Everybody tries to figure out what inflation is going to be in the future so that I could then be able to prepare myself and say to my employer, I want an increase of X% because I expect inflation to be X% in the future. But inflation might not be what I thought it is going to be in the future, in which case I want to be compensated for the uncertainty. And that uncertainty we call the inflation premium. The third component is, if I lend this money to Tim, will he be able to repay the money in the future? Put simply, is Tim creditworthy? And based on my view of the creditworthiness of Tim, I would then say, okay, I will charge you an additional premium. That premium, if you are a country, is called the country risk premium. So those three components determine the borrowing rate of government. Now, where does the central bank come? The central bank comes on the first two. To the extent that the central bank is able to keep inflation low, it means it brings down the borrowing cost of government. To the extent that the central bank makes inflation predictable, it brings the risk, the inflation premium of the government lower. The country risk premium is what government controls. And what goes into that risk premium? What's the credit worthiness of a country? Then it goes into what is the debt level of the country? What is the deficit of the country? What is the growth rate of the country? What are the social tensions in that country? What kind of institutions does the country have? Do the institutions work? All of those things go into the country risk premium. And that is what the rating agencies assesses your ability to service your debt on. Thus, in the realm of government and the national treasury, the central bank has got an impact on the first two components of the borrowing rate of government. Now, if you add all of those three, and at the moment government borrows money, if government borrows money today to repay you in 2030, they are paying 9.05%. If you have to borrow money to repay in 2030, there is no way you will lend that money at 9.05. Any lender will want compensation because your credit standing is not the same as that of government. So, put simply, if us as a country do not contain inflation, do not make future inflation predictable, do not bring down the country risk premium, this government will be borrowing at higher rates, which means all of us will also be borrowing at even higher rates. That's how we think about it.
I want to ask you about the makeup of the government debt at this moment. How much of it is foreign, how much is local? Because somewhere I'm imagining that there was also a risk of sorts to citizens who invest, for instance, in insurance companies, in banks, and so on, because it must be coming from some financial institutions, domestic in particular. Just give me a sense of how much of the makeup of the debt is and how much of it is foreign or...
Well, naturally, we do not comment on that because it's the National Treasury's point. The only time we start assessing this is in terms of our second mandate, which is financial stability. Yeah. And so we would then assess what this composition of debt and the interactions with respect to that, what it means for the country risk premium, and as such, what is it going to mean? Because the country, I'll explain why.
But I'm imagining that the ratings agencies are asking those types of...
They will ask those questions.
They're looking at
yes,
that,
but yes, they will be asking the Treasury those questions. But the last time I checked, 90% of South Africa's debt was domestic debt. It's held by pension funds, domestic pension funds, domestic insurers, and so forth. And then 10% of the debt is denominated in foreign currencies, borrowed offshore. In the 90% that is there, about 30% is bought by foreigners, which means that we had borrowed that money from foreigners, but in our own currency. And so from a financial stability perspective, which is where we come from, we look at that and says that the country is cushioned because it borrows in its own currency, and that is how far I can take it.
It does have a bearing on the stability of the currency, this particular point. Am I correct?
Well, the stability that I was talking about is broader financial stability. It might
I'm asking in the sense that there wouldn't be a run on the South African currency, for instance, if the bulk of the debt was foreign denominated, and then people wanted to exit South Africa, that would have some impact of sorts.
Well, it will have a big impact, because what it would mean is that the cost of the debt in domestic currency will go up because your currency had depreciated. But South Africa is, from a financial stability perspective and from a sovereign perspective, South Africa had managed that risk pretty well.
Lesetja Kganyago is the governor of the Central Bank of South Africa, and we will be continuing our conversation with him about the economic situation. Of course, as we are all learning that money plays a central role in our economy.